Next part of market context that I use is gauging new buying versus new selling. So if you are looking to be bullish on a stock, what you want to see as we move up is new buying form. And we could tell if new buying does form if we see demand form as we move up. Now, if the market wants to continuously move higher, you want to see new buying come in as prices move higher because that's telling me new buyers are entering despite the market being at a higher price. Same thing on the downside. If you see the market coming down, you want to see new supply form as we move down because that's factoring in new sellers being attracted to the market at lower prices as the market's coming down. However, there are some cases that price could move up without demand forming, and there's some cases that price can move down without supply forming. And what I've noticed in these two bullet points right here is the market, if it ever comes back to test the strong areas that the market moved up without any new imbalances forming, those areas are not very reliable, and price tends to destroy that area that we moved up or down in like it wasn't even there. For example, pull up TOS. Let's just ignore this part. But here we have a straight move up, and this is only on a 90-minute. So I'm sure if we go to a 30-minute or an hour, we could maybe find something. But let's act like there's nothing here, and this is the only time frame we see it on. There is no red basing candle for demand, and that's kind of telling me that there really isn't new buyers coming into the market. And what this could suggest is if price moves up without demand forming, either you have shorts covering because when shorts cover, they have to buy their position and it fuels a move higher, or sellers are not really passive at all. They're lifting their offer, and there's really no sellers in the market, so we can move up. We don't really know this without gauging too much of the larger picture and the larger story behind this, but same to the downside. If we were to flip this, the market was moving down and straight red candles down, there's really no new supply, no new selling. Two things could happen there. Either longs are liquidating and the market's coming down. What I mean longs liquidating is basically anybody that was long, let's say down here, the market moves up and we sell off without any basing periods to the downside. Those longs are selling their position, fueling move down, or buyers are not passively eager to enter the market. They lift their bids and the market could move down. So just because we move up or down doesn't mean supply or demand forms. You have to use it in context with each other. It can move up without an imbalance forming. However, for strong moves to sustain on the upside, you want to see new demand form as we move up. I mean, if you look at this picture, I'm not going to go to smaller time frames, but I'm sure there's some type of demand in this area. I'm sure there's some type of demand in this area. Same thing over here that we bounce at. So I'm sure, you could play with the time frames and see it, even this case right here. So let me remove this. The market moves up. As we move up, we create 90-minute demand here. We create 90-minute demand here. That's what you want to see on a strong move to the upside. Same thing on the downside. You want to see strong supply form. For example, in this case right here, this is a supply zone. I'm sure if you go to this is a 90-minute, so if you go to a 2-hour, I'm sure this would be a supply zone. This is a supply zone. So on the moves down, you want to see supply form. On the moves up, for strong moves that find continuation, you want to see new imbalances form. Now, go back over here. What this tells me and what this suggests my theory to be accurate is when the market bases out and we do create new imbalances, that's big money leveraging into their position. So it's safe to say we have a new buyer or a new seller in the market at that level. When there's a lot of participation at a specific level, hence we get a basing out period, that's telling me the market was in equilibrium. When the market is in equilibrium, it's very easy to leverage into a large position in hopes for a move up or in hopes for a move down. Obviously, we have a red basing candle right here, a drop, a base, and a rally. So that would suggest demand, and we have new buyers in that area. So when the market then does come back to test that imbalance, you want those new buyers, you want those new sellers to defend that imbalanced area. For example, this 90-minute zone at the top really did not work out. However, we came to essentially where the trend first started. I mean, this is at the pivot point before this 40-point rally, where we bounced at that. Buyers that were here defended that move to the downside. Now we're going to get into the context behind this. So keep in mind this little area as we go into the next slide. Now I'm going to combine these two with knowing your competition, because in my opinion, you can learn a lot and put good trades on if you understand where your competition's at. So put all the pieces so far together. When everybody's short, think of where you could be a bull. And when everybody's long, think of where you can be a bear. So you all know I don't like following the crowd. I like doing the opposite. That's the whole concept and mechanics behind supply and demand. When everybody's long, we have to think where we can be short And when everybody's so short biased, they think the market's going to tank. We have to think and look where we could be long or be a bull. Put yourself in the shoes of your opponent. Visualize where majority of buyers or sellers are. Where would they stop out at? Where would they enter? Where are they looking to take profit? The way I look at it is the market takes from many and gives to the few. So understand where the many are at, where the majority is at, usually at balanced periods where we really don't want to trade. And it gives to the few, the ones that make the moves in the market. So going back to the chart, putting yourself in the shoes of your competition, or even putting yourself in the shoes of the same participant that you want to be on. So we created 90-minute demand over here. Try to break this down. This kind of be a good context example, basically putting it all together just by the first two lessons. So we created this 90-minute demand. We bounced at it once. The buyers that formed on Tuesday, right over here, that formed that demand, held that area at that demand imbalance. We see nice lower wicks here indicating buying pressure, and the market starts moving up. Now, one thing I do want to note here is we did have supply, and another validation to suggest strong buying is not only the wicks, not only the bounce at the demand, not only buyers defending that demand, but we sliced through this supply zone like it wasn't even there. So now that we're above it, this becomes invalid. The market starts moving up. I'm sure there were some trades in this area over here. We reject this supply zone perfectly. Beautiful rejection off of that. Then the market starts moving down. Now, if you were to look at this picture and put yourself like you can't see time, we are putting in lower highs, we are putting in lower lows, and the market does look extremely bearish to the downside. Now, at this point, I remember this was back in late April. Everybody was super bearish the market for some reason. Coming to all-time highs, the market was failing. We were making these lower highs, we were forming supply, we were selling off. Like I said, you could get nice trades. But everybody was super bearish. So now that I had that in mind, I knew that a lot of people were extremely bearish, especially that on Tuesday, the market aggressively sold off. This is a 90-minute chart, so if you were to go to a smaller time frame, you would see a nice 30, almost 40-point move to the downside. Everybody was super bearish this. Keep in mind, we're coming back into that 4117 and a quarter area that proved to be very strong in an area where buyers were very present in the market. We moved down, and guess what happens at this zone? Price starts consolidating right here. We drop, we base out, not candle structure, but market structure wise. We have a base, we have a drop, we have a base, and now we're just waiting for a move up. Now, if we were to go to a 30-minute time frame, just to see what was going on, smaller, we would have a drop, a base, and a rally over here. And overnight, we were completely sideways, consolidating at this small area. So now we have demand forming inside of an old existing demand zone. So there's your fourth or fifth reason now telling me buyers are very, very strong at the 4120 to 4117 demand area. Then overnight, the market moves up. Then we come back down before the market opens right into this area. Now, keep in mind, we'll go to a 15-minute. So this is the type of analysis that needs to be done. 15-minute. Here's the 90-minute zone. Okay. So the day prior to that, from that amazing drop where everybody was super bearish, if you didn't realize we had demand imbalance here, we double bottomed, we triple bottomed, whatever you want to call it. So there's your sixth indication that buyers are super strong there. I mean, we think the list just keeps going on, right? We created a 15-minute supply zone at the open from that drop the day prior. So now that would be a good reference area for the day before. But because of the context suggesting we have 6 different reasons why buyers were super strong at this demand zone, this supply zone becomes very less reliable for me because of the participation of buying down here. So the market bounces off of this demand zone. That was a good trade for those that did take it long. And on a 15-minute chart, we rallied to the upside right into the supply zone. I remember I did take this trade long, speculating that this 15-minute RBR was forming. And I took profit as soon as we came into supply. So this is what it looks like as the market's developing. I don't know if I included this, but this is now the 7th point of suggesting strong buying into the market because now we have new demand forming as we move up out of this old existing demand zone. The market does move up. This 15-minute supply zone really is not met by selling, and because of that context, really no reason to short it. The next candle also sets up for a 15-minute RBR. However, the following candle after that dips back down into this 15-minute zone perfectly. And then look at the following candle after that. Rally right past bouncing off of that 15-minute. So I'm sure if you were to go to a 5-minute without confusing everybody, I definitely recommend going back and listening to this example again if you're a little confused. But here's that 15-minute RBR. We come back down, test that 15-minute RBR. Bounce off of demand. I'm going to invalidate the supply now. So now we have new buying here. We have new buying here. And the market starts rallying. That's your 8th point of strong buying over here. Then the market closes up pretty strong. The following day, let's go to a 15-minute now. The following day, we open up pretty flat, and keep in mind the buyer's here, the buyer's here. And if you were to go, you could use a 15-minute, but I believe there was one on a 30-minute. As we move up, new buying comes into the market. We want those buyers to defend that area. So right here, it's really not too clean. It looked a little better on the 15-minute if you want to go back and use it as reference. But it was technically a drop, a base, and a rally. Not a fan of that upper wick. If we were to make this green. So on Tuesday, as the market, or on Wednesday, as the market moves up, we create multiple different imbalances. The following day, we pull back, to the tick, bounce off of that demand zone. If you go to a smaller time frame, you could have sniped a good entry to get long, and then the market starts rallying. And then we have, this is Thursday, pretty sure this was a Fed announcement, 1 o'clock. I believe there was some type of news, but that's going to lead us into the example a little later on about news being a good area for context. But that's essentially how I gauge the context. We sliced through that supply. We created different demand down here, double bottoming. We saw wicks, also a very key area from a few days prior. So it's just adding the little pieces together, combining everything, getting the full story, and then going to your smaller time frames, sniping an entry, and taking a trade with proper risk management, especially that on Wednesday we sliced through supply and created new buying on the way up, indicating strong buyers. Then eventually we pulled back down. And then look, that drop off news, I don't want to get into it on this video, but dropped right back into that 4120 area. So it's just doing that type of analysis. Go back and listen to this video again if you need to. But just understand where your competition's at. If everybody's bearish, try to be a bull. Visualize where a majority of buyers are and sellers are in the market. Where would they stop out? If you're near a resistance area, the majority of shorts are going to stop out above resistance. That goes back into my confirmation video about trapped retail and low a day or high a day fake outs. Just put yourself in the competition. If you were a buyer at a certain level, how would you trade? How would you react? For example, if you were long down here at this demand, if the market's moving up, you're in no pain. You're happy. You're not worrying about stopping out. So that could fuel another move higher. So a lot of different scenarios. Play around with it and let me know.